Hey everyone, and welcome back. In today's video, we're going to be talking about the 4 reasons why you would want to sell a business or a stock that's in your portfolio. So on this channel, we talk quite a lot about the buy side of investing, analyzing businesses, making sure they're great businesses, figuring out what price to pay so that we can make a consistent return. But we don't talk a lot about selling businesses. So that is what we're going to cover in today's video. And we're going to go through, as I said, 4 different reasons why you would want to start to sell a business. And not only am I going to explain what these reasons are, but I'm going to show you exactly how you can identify them straight away in the businesses that are in your portfolio, so that you're not just going to watch this video and then click on the next video. You can watch this video and then take some action in your portfolio to figure out if any of those businesses in there should no longer be in your portfolio. So without further ado, let's get straight into reason number 1. The first reason that you would want to sell a stock that's in your portfolio is if you no longer understand the business that is behind that stock. And there's a couple of forms in which lack of understanding can take its shape, even if you do understand the business when you are initially investing into that stock. The first way is if the business moves into a new industry by starting to sell a different product or service that may be in a completely different industry than their previous business. And an easy example that I can provide for you here is Facebook over the next decade or the next 15 years. So up until this point, since Facebook begun, their main business has been advertising. So they have an advertising platform, they have an algorithm that allows businesses to put their advertisements in front of targeted audiences on the Facebook platform, on Instagram, and some of their other platforms. But more recently, they've been doing a lot of investments into the payments industry, which, comparing payments to advertising, there are some minor overlaps in terms of e-commerce being an industry in which can capitalize and benefit from using advertising on Facebook, and then the payment system in order to allow easy transactions between small businesses and e-commerce platforms. But the payment system is vastly different from the advertising industry. So it's there would be many people who over the past decade may have been investing in Facebook and invested in Facebook based on the fact that they had a deep understanding of advertising, but do not have an understanding in the payments industry. And that is a problem, because if you don't understand a part of a business that, for Facebook at least, I think payments is going to become a huge part of their business, maybe even as big as their advertising business. And if you don't understand that part of their business, then you're not going to be able to make good investment decisions going forward with that business. Meaning, you're not going to be able to accurately predict what are the future cash flows going to come from that part of their business. But there is also another way in which you can go from understanding a business to not understanding a business, and that reason is innovation in the industry that changes how that industry functions. And a good example of this is the transition that the automotive industry is going through and will continue to go through probably for the next couple of decades at the very least. So in the automotive industry, for a very long time, automobiles were made with combustion engines. There was there was all these different types of cars. For the most part, the core inners of those cars have been the same. But more recently, there's been a dramatic shift towards electric vehicles. And that shift is probably going to continue to go until there are no longer any or very little combustion engine cars, and to where all cars will be run on electricity. And that is a dramatic change in how the industry operates and the types of materials that they need, the operating line, the manufacturing lines that they need in order to produce those cars, and the dynamics of how those businesses operate. A Tesla, for example, vertically integrated, not having any dealerships, is a very different business to how many of the previous automotive businesses have operated. And that is a case in which innovation has caused a dramatic change in the industry. And there would be many, again, same as the Facebook example, there would be many investors who deeply understood how the classic automotive business worked, but would not understand how an electric vehicle functions, what parts are required, and how that business will operate going forward. So what do you do in this situation? What do you do if you are a Facebook investor who understands the advertising platform, but you don't understand how payments work? Well, there's one of two things that you can do. One is that you can try and learn deeply about that part of the business. And this means that really what I mean by that is you need to end up being able to figure out how much cash that part of the business could produce for your business. You need to be able to wrap your head around the end-to-end process that Facebook goes through in order to generate revenue and then cash flow in the payments industry, for that example. And if you can't do that, then you cannot hold that business in your portfolio, because when Facebook stock crashes next time and you don't understand a significant part of their business, you are going to be so scared and you're going to sell your stock at a loss, which is the worst thing that you could do. So if you don't understand the business, you're not going to have the confidence to know where that business can be in the future. And as a result, you should not be in that investment. You should move that money into a business that you do deeply understand. The second reason why you would want to sell a business in your portfolio is if it no longer has a distinct competitive advantage. So competitive advantages is the second part of the analysis process that we go through. So if you're following the Warren Buffett principles and the process that I teach on this channel, then the businesses in your portfolio all have a distinct competitive advantage, or at least they did at the time of your initial investment. But competitive advantages can change over time. We just spoke about a couple of different ways in which industries can change dramatically, or how a business can move into a new industry, and those changes for the business and for the industry broadly can impact competitive advantages. And an obvious example that we could talk about that's been unfolding over the past couple of decades is the competitive advantages that department stores and other retailers used to have prior to the internet and the rise of e-commerce. So prior to the internet and the rise of e-commerce, many department stores, or the really big department stores, clothing stores, they had a couple of key competitive advantages, or at least some of them did. For starters, a lot of them had branding advantages, a reputation, and the other thing that they had was a cost advantage, because when they are operating at such a big scale and they're ordering tons of clothes or tons of products all in bulk, they have huge advantages over the smaller retailers that have to charge more in order to operate. So they had distinct competitive advantages in many cases. But now that e-commerce came along, they have lost their cost advantage completely, because the cost to run a department store with bright lights and air conditioning is so much higher than an e-commerce store like something that Amazon runs, where they don't have any physical stores. They have a warehouse. It doesn't need to be lit or set up, in such a way that is good for customers to come in and find products. They find their products online and the warehouse just ships it out to them. So they've completely lost their cost advantage, and many of them have also had their branding advantages weaken over time. So that's an example of how a business may lose its competitive advantage over time. And if that is the case, if the business loses its competitive advantage, then we can no longer be confident that that business is going to thrive over the next 10 years and produce us a substantial return. So that is another case of a business that you would no longer want to hold in your portfolio. So in a business that you hold, how can you identify that a competitive advantage is slowly going away? And this is a tricky one to identify, but there are 4 key numbers that demonstrate to us whether customers are consistently coming back and spending more money at a business. And those 4 key areas are revenue, earnings per share, equity, and free cash flow. And when we are first analyzing a business and looking for competitive advantages, we are looking for these numbers to be consistently above 10% over the past 10 years, growing at over 10% over the past 10 years. And in the best cases, their growth rates are increasing over shorter and shorter periods. And in businesses that are losing their competitive advantages, their growth rates will be slowing substantially over time. So they will be going from a business where they used to be able to grow at 10, 12% over a 10-year period to now their growth is slowing down to 6%, to 4%, to 2%, and maybe even they're entering negative growth, meaning that less customers are coming back and they're spending less at these stores or whatever type of business it is. And that whittling away of those growth rates, their inability to continue to grow at a high rate, consistently attract new customers and maintain their existing customer base is a very quantitative way of looking at whether a business has lost its distinct competitive advantages that once allowed it to grow at a high rate. The third reason that you would want to sell a business in your portfolio is in relation to management. And there's two sort of key things that we need to see in management in order for us to continue to hold that business. And those two things are they need to be trustworthy, transparent, honest with us, their values aligned with us, and they need to be skillful at their job. So they need to be telling us everything that is going wrong in the company, being clear with us about the reality of the business. And then they also have to be good at their job so that they can make good decisions internally, keep debt to a low level so there's a low risk to shareholders, and then ultimately generate the maximum amount of cash flow for us as shareholders. And in some circumstances, when you make an investment initially, management may be one of the areas that you had neglected to look at thoroughly. I find that I get a lot of questions about whether management is as important as competitive advantages and intrinsic valuation and understanding the business. So that kind of gives me the indication that a lot of people neglect the management part of analyzing a business. And that's something that leads people into businesses that have untrustworthy managers. But maybe 6 months down the road, 12 months down the road, you do some more digging into the management team and you find out that their values aren't quite aligned with yours, and their interests are in fact in making sure they make the most money, and the long-term returns for shareholders are not in their best interest and not at the forefront of their investment decisions. But more commonly, the reason why a management team would go from being trustworthy and skillful to no longer trustworthy or no longer skillful is if there is a change in power. If there's a CEO that retires and a new CEO comes in, if a number of members on the board of directors or in the executive team change, then you're dealing with a new management team that you now need to reassess. And this can be quite tricky because when you're looking at a company's last 10 years and you're looking at the track record of the business, if a CEO has been there that entire time, then in many circumstances you can use the track record of the business as an indication of how skillful, for example, the management team is, because they were the ones that were making all the decisions that led to that great 10-year period. But when you switch to a new CEO, sometimes you don't have any track record for that CEO. Maybe they weren't a CEO of another company, because if they were, you can check their numbers and have a look at how he did at that company. But in many circumstances, they were within the company, but they were lower down in the company, and now they're the CEO, or they were lower down and now they're on the board of directors. So it can be quite tricky to assess whether you trust a management team immediately after a new CEO comes into power. So often when it comes to a new CEO, you need to kind of make a decision. You need to either say, okay, I don't trust the CEO. I don't know if he's going to be good at his job, so I'm going to get out of this business. And that might be a reason why you want to sell. Or you might trust that that new CEO has been selected well by the board of directors who existed while the company was thriving previously, and maybe you give him a few years in order to prove himself. So that's a decision you have to make, and this is probably the most challenging part when it comes to figuring out when to sell. But as I've said throughout this video, generally, if it is a great business and I trust the management team initially and they bring someone in new that they trust, then I'm generally going to try and be a buy and hold investor, hang on to great businesses over the long term. That has been the strategy that has worked for me, and it is what I want to do over the long term with my investments. And then finally, reason number 4 that you would want to sell a business in your portfolio is, of course, because if it became too expensive. So sometimes the stocks in your portfolio, well, sometimes they're really cheap and we want to buy more of that business. Sometimes they're in the middle and we're not really doing anything. And sometimes they get really, really extremely overpriced. And in those circumstances, it is better for us to sell that business, get some cash up front, rather than holding onto that business over the next decade, because then we can put that cash to work in a business that is at a better price, of course, given that it is a great business initially. Throughout this video, I've been telling you that I am mostly a buy and hold investor, and that basically means that when I find a great business that I think I deeply understand, that has competitive advantages that are going to allow it to thrive over the next decade and beyond, and they have a great management team who cares about the long-term interests of the shareholders, then I want to be holding onto those businesses and stockpiling, building my ownership in them consistently over the long term. And that means that in most circumstances, I'm not going to be selling even if the price gets really, really high. But there is a circumstance in which I would sell because the price became to a certain point. And that point is at which the price is way higher than the intrinsic value of the business. And there are quite a few different definitions of intrinsic value, so I'm going to give you mine so that you understand what I mean by a business's price being higher than its intrinsic value. What I mean by intrinsic value is my estimation of the total amount of cash this business can produce for me over its remaining life, discounted at the risk-free rate. And at the moment, the risk-free rate is about 0.6% or something like that. So more or less at the moment, the intrinsic value of a business is the total amount of cash flows that I think I can get out of a business over its remaining life. So that's a pretty high bar. I don't know any circumstances, even when the markets were really expensive, in which a business that I owned or a business that I saw had a price that was higher than the total amount of cash I thought I could get out of it for its remaining life. And if that's confusing, then this is the way to think about it. If a business's price is higher than its intrinsic value, then that means that I can get more out of that business by selling it now than I could if I held it for the rest of my life. So it's a very high bar in which I would start to sell a business. And for the most part, if a business gets really expensive, I'm going to hold on to it, let it run, because sometimes businesses outperform your expectations. So even if you think it's getting really expensive, maybe it's getting expensive compared to your conservative estimations of how it can grow in the future, but maybe it's going to outperform. And businesses that are great, that pass our milestones, in many circumstances, they will outperform your expectations. So I want to let those businesses run. I want to hold on to great businesses, and I don't want to limit the returns that I can make in businesses that I think are great and that I've purchased at an appropriate price. So that covers the 4 main reasons why I would want to sell a stock that's in my portfolio. And those 4 reasons, I gave an example here and there for some of them, but broadly speaking, those 4 categories basically cover every reason why you would want to sell. Either it's got something to do with you not understanding the business, either it's got something to do with whether the business has competitive advantages, or it has something to do with the management team, something going wrong there, or it has something to do with the price being too high. So those areas are where you want to be thinking about when you're looking at your businesses and whether you're considering holding onto a business or selling it. And I want to hear your thoughts down in the comment section below. Are you a buy and hold investor, or do you trade in and out of businesses? And if so, what are the reasons why you would want to sell a business in your portfolio, or maybe the reason why you've done it in the past? And if you're new around here and you want to see more content like this, then the best thing that you can do is hit subscribe and check out some of the other content that's on my channel. We have over 200 or 250 videos related to value or long-term investing, so go check those out. But for now, I hope you guys have a great day, and I'll see you in the next video.